Hey, it's Ben and Eric here. We're here for the Friday market update. We are halfway through 2025 officially, and what was supposed to be a year of lower rates and easier home buying has turned into a messy middle. So, here's what the numbers are actually saying and what it means for your next move. Now, the rates have been stuck between 6.6 and I don't know 7.10. Eric, tell me about the rates. Why haven't we seen the rates come below 6.6 this year when everyone was predicting 6.25, 6.4? What's happening with this?
Really what we're seeing is there is a lack of good information coming out as far as our economic reports. We are using some antiquated ways to formulate these reports. And what it is showing is that inflation has come down just like we were expecting. However, unemployment, due to really the way that they count people on unemployment and with new job growth, is antiquated in the way that they calculate it, and therefore is showing that really the jobs market, I think, is stronger than what is really happening out there. And because of that, we have a divided Fed. We have Jerome Powell citing that, hey, employment is stronger than I think what most people would agree that it is. And you have other Fed members who are citing this newer material and saying, no, it's time to cut. So really what we're happening is we have a divided market and they're doing nothing. They're sitting on their hands.
Yeah, it's what do you think we're going to hit the 6.25 or 6.4 by the end of this year?
I think there's a chance. What it feels like is there's going to be a cliff to me, is that at some point we are going to hit a point of no return and there is going to be a fall off. And that is going to happen when unemployment spikes and inflation is, which for the most part is in line now, stays low. So it's really becoming to a boil over, really, when you look at what the White House is accusing the Fed of doing. And a lot of it will be political and kind of who wins that fight.
Yeah, I would tend to agree with that. A couple stats with the local housing market. So our residential inventory is up almost 13% year over year. Our condo inventory is up over 31% year over year. Our month supply of inventory just keeps ticking up and up and up and up. So 2 years ago, we were below 1 month supply of inventory. Now we're all the way up to 2.5, and it just keeps trending upward. So buyers finally do have some options again, although it doesn't feel like it when we're out there.
No.
But the more inventory does mean more competition for sellers. So there is a little bit more competition for sellers right now. The sales are slowing. Okay, so sales are down. Residential sales are down 7.2% year over year. Condos are down 6.7% year over year. Pending sales have also declined for both residential and condo. So we have inventory creeping up, pending sales moving down, which tells me that inventory is getting a little bit higher than demand. That's what those numbers mean. So what we really need is the 6.25 or even the 6.4 maybe to level up the demand with the inventory. So the demand rises with the inventory to keep it more of a balanced market. And that's what I'm personally hoping to see. Given that information, our prices are still rising. We're still gaining value in our home. So if you're a homeowner, you are gaining value. The median sale price is up 6% year over year for residential. It's up 2.5% year over year for condos, but pricing is starting to soften just a little bit. But I will say, on average, Metro Detroit, 5% appreciation in the last year. Our time on market, our days on market are really creeping up. Again, that goes down to the demand being lower than the supply just by a little bit. I'm not talking about a huge differential there, but days on market year over year increase is 44%. So they're creeping up slowly. Buyers are taking longer, they're shopping more, and they're demanding more value. So we simply cannot price like it's 2021 anymore because it's not that market. So overpricing your home right now, that is a fast track to getting ghosted and seeing the high days on market. Hopefully we do hit that 6.25, 6.4, and we get some more balance back again. So Eric, final message.
Nope. I think you hit on it great. I mean, when we talk about down 7%. That's coming off a historically the worst year since 1993. So, I mean, when they're talking about things coming up, it's coming up off the bottom, guys. And right now it's not even coming up. So, really tough out there. Do whatever you can do. I would say now is still a time to get out there again, buy when no one else is buying.
Hey, I'm gonna put you on the spot, Eric, because you have an awesome new program that you just told me about that would really help people that want to buy now but take advantage of the lower rate later.
Yeah, no, 100%. We do a mortgage under management program, which essentially what it says is, hey, if you want to buy, and you're going to end up overpaying a little bit for this first year on your rate, but if you look at the cost of appreciation with that 5% that you talked about, Ben, year over year, let's just say it's a $500,000 house. That's a $20,000 gain. What we're doing right now is we are refinancing people into that next loan when rates do drop for little or no money out of pocket from them. We're going to waive all of our closing costs up front, and just to try and help people really be able to get into the market, get into a house now before demand increases and prices skyrocket again. So yeah, 100%. We love to help. We're just trying to find ways to make houses affordable during this time period.
I love that. I think it's a phenomenal program. Bottom line is we are still in a balanced market, but it is shifting to be an unbalanced market. Buyers, this is your best window in over 2 years. This is the best window you've had to buy a home in over the last 2 years. Sellers, if you want to be strategic and compelling, you have to price correctly, or you may miss the window to sell at top dollar entirely. So that's where we're at right now. Unless rates change, the market will change. But that's where we're at today. Thanks so much, Eric. I appreciate your time. Everyone who's listening, have a phenomenal weekend, and we'll see you in 2 weeks.